Not every product is created equal. Some are magnets for misuse. In this lesson, we'll talk about product and service risk, the risks linked to the financial products a company asks for, and how they plan to use them. We'll look at 4 things: the purpose of the relationship, the products requested, the expected transaction profile, and the funding methods. By the end, you'll see how these elements help us judge whether a business relationship is low, medium, or high risk. When a business asks for financial services, we don't just ask who they are. We ask what they want to use and why. Because product and service choices can quietly turn a low-risk client into a high-risk relationship. Purpose of the relationship. When assessing product and service risk, the first question is simple. Why does this company want to open an account or start a relationship with us? The stated purpose should always make sense in the context of the business. For example, take a small neighborhood retailer. Opening an account to process payments and manage supplier invoices is logical. But if the same business explains that its goal is to facilitate global trading operations, that purpose feels out of place and should raise questions. The purpose of the relationship sets the tone for all the other checks. If the explanation is vague, inconsistent, or doesn't match the company's profile, it's an early red flag. Products and services. The next step is to look at the actual products and services the company wants to use. Just like industries, not all products carry the same level of risk. Some are naturally lower risk, while others create much bigger vulnerabilities. On the lower risk side, think about basic services like simple current accounts, savings accounts, or term deposits. These products are straightforward, highly transparent, and typically easier to monitor. But then we have products that are considered higher risk for banks. Examples include private banking services, trade finance, correspondent banking, prepaid cards, and of course, virtual assets or e-wallets. These products can involve high-value transfers, multiple jurisdictions, or even anonymity, making them far more attractive to criminals. Imagine a small family-owned shop that applies not just for a basic current account, but also asks for trade finance and correspondent banking services. For a business of that size, those products make little sense, and that mismatch is a clear warning sign. So the key point is, always ask whether the product requested matches the company's profile. If there's a gap, that's where risk starts creeping in. Expected transaction profile. Another key element in product risk is the expected transaction profile. This is about what the company says its day-to-day activity will look like, the expected volumes, the number of transactions, and the typical payment sizes. For example, a small local business might expect a few dozen domestic transactions a month, each in modest amounts. That's a profile consistent with their size and operations. But if the same business predicts hundreds of large international transfers or unusually high volumes with no clear explanation, that's a mismatch, and it should raise questions. The expected transaction profile acts as a benchmark. Later, when we compare it with actual activity, it helps us spot unusual or suspicious patterns much faster. Funding methods. The last part of product risk is the funding methods. In other words, how the company plans to put money into its accounts. From a risk perspective, some methods are much cleaner than others. Bank transfers from reputable institutions are generally lower risk because they leave a clear audit trail. Card payments can also be relatively safe when they come through regulated providers. But when cash is involved, the risk goes up. Cash is hard to trace and can easily be mixed with illicit money. That's why cash-intensive funding, especially in large or frequent amounts, is always a red flag. For example, imagine a tech startup that claims most of its capital injections will come in as cash deposits. That doesn't fit with the profile of a modern digital business, and it's exactly the kind of inconsistency that should trigger further checks. Picture this. A boutique consulting firm applies for correspondent banking, trade finance, and a prepaid card program. Declared profile, 30 to 50K monthly, mostly domestic services. Funding method, frequent cash deposits from workshops. Movement, within 2 months, we see large cross-border wires to unrelated distributors, then repayments from a third country. Where are the mismatches? Purpose versus products, declared profile versus actual activity, digital consulting funded in cash. This is how product and service risk exposes itself, through inconsistencies. 3 things to remember. Purpose must fit the business. If the why is vague or oversized for the client, risk is already knocking. A clear, logical purpose helps you understand the true intent behind the relationship and spot inconsistencies early. Products change risk. The more complex, portable, or opaque the product, the higher the exposure, especially across borders. Even a legitimate business can become high risk if the products it uses allow funds to move too freely or without transparency. Profile and funding are your baseline. Unrealistic volumes or cash-heavy top-ups signal mismatches you can test against later. Treat this declared profile as your reference point. It's what future transaction monitoring teams will compare against.
If you found this lesson useful, you'll find the full Anti-Money Laundering Basics course linked below. It includes all stages, red flags, and practical exercises to help you build real compliance skills.